Hello, this is Sunko, the Korean bro, and today is December 7th. And let's see. Okay. Hmm. Mollyfood.com. What articles do we have tonight? Hmm. Palantir Technologies, Microsoft, hmm, and Warren Buffett's trading record. Uh, what matters? Hmm. Intel's okay. A heavily concentrated portfolio is not a concern for Warren Buffett. Berkshire Hathaway is a sprawling conglomerate worth over $770 billion. While its main business is insurance, much of Berkshire's value comes from its investment portfolio. Chairman and CEO Warren Buffett has generated incredible market-beating returns for shareholders through prudent long-term buy and hold investing. Today, Berkshire portfolio is worth about $361 billion, but just two holdings account for over 42% of Berkshire Hathaway's entire market capitalization. Here they are. Apple. As Berkshire's annual meeting in May, Buffett called Apple a better business than any we own. He said he'd love to own more of the company, and he continually claims a greater share of the business thanks to Apple's generous share repurchase program. Today, Berkshire's 915 million plus shares of Apple account for over 48% of its equity portfolio. They're worth about $173 billion, or 22.5% of Berkshire's market cap. There's good reason for investors to like Apple so much. Its position itself as the platform owner when it comes to smartphones, taking a more than 50% market share in the United States. Around the world, it counts over 2 billion active devices. Its combination of hardware, software, and services make its product extremely sticky and allows it to integrate products to work closely together. Often users are more likely to buy another Apple product than a non-Apple alternative, creating a virtuous cycle of growing product sales. But the services segment is where Apple is seeing most of its growth lately. That's bolstered by its growing active device user base. Growing active device user base. As a platform owner, it's able to exercise a lot of leverage to monetize its users through services, including its App Store, where third party developers can sell their software to iOS and Mac users. That all results in tremendous amounts of cash flow every year. Last year, the company generated $110.5 billion worth of cash from operations. It uses all that cash to return money to shareholders through a robust stock repurchase program, with $77.5 billion repurchased in 2023 and a modest dividend with $50 million in dividend payments in 2023. While the shares trade around 29 times 2024 earnings estimate, Apple deserves a premium valuation, but not because it has outsized growth opportunities, although the Vision Pro and its AI bets could turn out to be big opportunities. Vision Pro and its AI bets. The reason it deserves the evaluation is the Apple's strong net cash position of $57 billion and the massive buybacks distort the multiple that long-term investors pay for future earnings. While Apple has Buffett's largest stock position by far, investors should consider the stock themselves, and there's no need to be concerned about how heavily concentrated Berkshire's position is in the stock. Okay, let's see. Okay. Tesla's reach margins have been falling of late thanks to price cuts. However, it just unveiled the Cybertruck should boost revenue and margins. The stock is highly priced, meaning that investors need a long-term perspective. Okay, Tesla is still the best in its class, even with its struggles. If you're looking to invest in electric vehicles, there's one glaring option available in the market, Tesla. While other up and coming EV makers and legacy companies are starting the transition to an electric fleet, Tesla still stands above its competition in terms of investment quality. It's not a perfect investment, but Tesla is still the top EV stock to buy right now. Here's why. Its margins have been under pressure recently. Tesla is far and away the leader in the US EV market. In the third quarter, over 313,000 EVs were sold, up nearly 50% from last year. Of those EVs, about half were Teslas. This shows Tesla's dominance, and a new product could widen its lead. With Cybertruck deliveries now beginning, Tesla has another revenue stream that will be activated after investing a lot of money into its EV truck line. It could also help reserve a concerning trend for Tesla investors. One of Tesla's biggest advantage over its legacy rival was its gross margin. Hmm. Tesla's input costs were much lower than those of its competitors, so it could produce a greater gross profit. However, now that Tesla has slashed prices to stay competitive with other options in a rising interest rate environment, its gross margin has deteriorated to the point where it's nearly in line with traditional automakers. Okay, however, some of the highest margin vehicles for makers like General Motors, Ford Motor Company, are their pickup trucks, which often have gross profits over $10,000 per vehicle. This far outweighs the margin on typical sedans. Some of the highest margin vehicle for makers like General Motors and Ford Motor Company are their pickup trucks, which often have gross profits over $10,000 per vehicle. This far outweighs the margins on typical sedans, making it worth paying attention to what kind of profit margin investors can expect from the Cybertruck. If Tesla can pull off superb margins with its truck, it will receive a much needed margin boost. But even if it doesn't, having a strong pickup offering a key for competing in the US market. As the top three selling vehicles so far in 2023 are the pickup launched from the Big Three. Um, as top three selling vehicles so far in 2023 are the pickup launched from the Big Three in Detroit: Ram, Chevy Silverado, and the Ford F Series. Now that Tesla has a viable option, it could capture some market share as the other three introduce their EV pickups. But even without pickup in its lineup, Tesla is still doing fine. In quarter three, its production numbers were up 18% and deliveries increased by 27%. Its production numbers were up 18% and deliveries increased by 27%. But because of price cuts, its revenue only rose by 9%, while net income declined by 44%. Investors will need to keep an eye on prices, but if Tesla can raise prices once interest rates rise, it will clearly demonstrate whether the company has pricing power. If Tesla can exercise its practice, it will solidify the stock as solid investment. Additionally, Tesla has the upside of full self-driving capability and a subscription product that could bring in massive revenue once it's fully built out. But many of those points are in the future. What about now? An investment in Tesla is an investment in the future. There's no way around it. The stock's current valuation makes no sense to investors with a short-term mindset. Tesla's 77 times trailing and 75 times forward earnings are incredibly high valuations to pay for any company, let alone an automaker. So if you're looking for a short-term bargain, Tesla isn't your stock. However, if you think it can raise prices once interest rates decline, capture a chunk of American truck market and deploy FSD or other long-shot Tesla technologies, then the valuation makes no sense. Tesla is a 5-year investment at minimum, unless something drastic changes with the company. The Sachs, Alibaba. Hmm. Mm, just for goose sake, let's read this one. Okay. Many people look forward to retirement because they can't wait to reclaim their time and stop reporting to a boss day in and day out. If you have a notably stressful job, that's certainly understandable. However, a fair number of people also end up retiring only to return to work in some capacity after the fact. This decision often stems from a financial need. Isn't the only thing that should have you considering a post-retirement return to work. You may find that holding down a job is just the thing that makes your senior years more meaningful and even enjoyable. It's not just about money. In recent Empower survey, respondents were asked about their reasons for potentially going back to work after retiring. Personal fulfillment as reason to return to work after retiring. Okay. Okay, let's see. Warren Buffett believes an enduring economic moat is one of the most important qualities a business can possess, and moats generally boil down to pricing power. Apple has that in spades. An enduring economic moat is the one of the most important qualities a business can possess, and moats can generally boil down to pricing power. Its ability to pair appealing hardware, proprietary software, and services creates a unique user experience that has led to profound customer loyalty and brand authority. Those qualities allow Apple to charge a premium for its products. The average iPhone sells for 3.5 times more than the average Alphabet owned Android smartphone. Customer loyalty and brand authority have also helped Apple achieve a strong presence in several consumer electronic markets. Apple is the largest smartphone manufacturer in the US and second largest smartphone manufacturer worldwide. It is also the fourth largest personal computer manufacturer globally. And the leader in tablets and smartwatches. Collectively, the hints at me single digit revenue growth in hardware through 2030, simply because the broader consumer electronics market is forecasted to increase at 6.6 times 6% annually during that period. However, those products are only the first half of the equation. The second half is the services ecosystem that Apple uses to monetize its installed base, which currently exceeds 2 billion devices. Those services include Apple Store sales, iCloud storage, Apple Pay, and subscription products like Apple TV Plus and Apple Music, among other ancillary revenue streams. Apple services business is particularly compelling because it earns higher margins than the hardware businesses, and the company has strong presence in several relevant markets. For instance, the Apple App Store makes twice as much money as Alphabet's Google Play Store. And Apple Pay is the most popular in-store mobile wallet among U.S. consumers. Apple Pay is the most popular in-store mobile wallet among U.S. consumers. I think Apple could achieve high single-digit revenue growth on an annual basis through the end of the decade, provided the company continues to grow consumers into its service ecosystem. Apple's full-year financial performance left much to be desired. Apple reported lackluster financial results in fiscal 2023. As difficult economic conditions weighed on consumer spending, total revenue dropped 3% to $383 billion, driven by declines in every device category, offset by a modest increase in services revenue, as detailed below. Additionally, despite an 80 basis point expansion in gross margin, net income still declined 3% to $97 billion as operating costs continued to climb. However, earnings per share actually increased because Apple plowed $77.6 billion into its stock buybacks. That bodes well for the business because the services segment will likely be the primary growth driver going forward. App Store, Apple Care, iCloud, Apple Pay, and Apple TV Plus. Apple stock quadrupled over the last 5 years, but shares look expensive. Apple is a wonderful business with a durable economic moat built on brand authority and proprietary technology. Those qualities afford the company a great deal of pricing power. To that end, Apple has been an extraordinary investment in the past. The stock soared 328% during the last 5 years. However, I doubt shareholders will see anything close to that over the next 5 years. The stock traded 15 times earnings 5 years ago, a much cheaper multiple than its current valuation of 31.3 times earnings. But the multiple itself is not necessarily important. What matters is not how quickly Apple can grow its bottom line in the future. Wall Street expect annual earnings growth of 10% on a per share basis over the next 3 to 5 years. That forecast makes its current valuation look quite expensive, so I plan to steer clear of Apple stock for the time being. But Buffett clearly has high conviction in the company, so I would not fault anyone for buying a small position in Apple stock today. The last piece of advice I would offer is that readers should not allocate half of their portfolio to any single stock. Buffett is a highly skilled and highly accomplished stock picker. His lead is almost always worth following. But diversification is important for the vast majority of retail investors because it reduces risk. One Kathy Wood stock by December that dominated Black Friday and Cyber Monday. Shopify increased gross merchandise value of 24% year over year during the Black Friday to Cyber Monday weekend. New research suggests that brands have defaulted to promotions for much of quarter four, not just for holiday weekends. Given this dynamic, Shopify may stand to benefit from a prolonged period of discretionary spending this year. Gross merchandise value. Gross merchandise value were even better than last year. Agi Invest founder and CEO Kathy was known for investing heavily in emerging technology companies. One of the top holdings among her exchange trading fund is commerce platform Shopify. If you've ever made a purchase from an ad on Facebook, Instagram, or other social media platform, chances are you've used Shopify. The company supports both large retailers and small to medium sized enterprises by helping them sell products, market the business, and manage customer expectations. Given that the holiday season is underway and consumers are out shopping, this is an important time for Shopify. Hmm. Though the stock has more than doubled year to date, it's still trading nearly 60% off its all time high. This presents investors with long term opportunity in a leading e commerce company. An impressive holiday weekend. Following the Thanksgiving holiday in US, consumers flocked online and to brick and mortar retailers to take advantage of Black Friday and Cyber Monday promotions. In Shopify's early November earnings call, management stated our expectations for growth in quarter four reflect the continued strength of our business. And the year over year growth rate reflects a tougher comparison to quarter four of last year, which was our highest quarterly growth rate last year and included particularly strong Black Friday Cyber Monday weekend. Specifically, management was guiding for year over year growth rate in the low to mid 20s, down from the 30% growth reported in quarter three due to last year's robust holiday season. But according to a preview of Black Friday and Cyber Monday results, 2023 has turned out even better. During this holiday weekend, Shopify merchants generated $9.3 billion in gross merchandise value, up 24% year over year. Moreover, last year, 52 million consumers purchased from Shopify powered brands, but this year that figure increased to 61 million. The company also saw a 60% increase in purchases made with Shopee Pay. The company's online checkout feature. Although the results above are encouraging, these figures are just for one weekend. The holiday season is still in full swing, and the Black Friday weekend activity hints at what's to come in December. But what about the economy? Okay, when it comes to the macroeconomic environment, it's understandable for some investors to be cautious regarding trends in consumer discretionary spending. While the Federal Reserve has moved aggressively to combat inflation, October's inflation rate of 3.2% was still higher than the Fed's long term target of 2%. That said, there are reasons to be hopeful this season. According to consulting firm McKinsey, the continuous year-end promotional cycle has been underway since September. This means that brands have resorted to an early start on the holiday shopping season compared to prior periods. Given this dynamic, it's possible Shopify has been experiencing an uptick in activity for the entirety of quarter four, not just during holiday weekends. Moreover, the McKinsey report also found that 19% of its survey respondents prefer buy now, pay later. Optionally, when it comes to shopping, not only is the BNPL feature of Shop Pay, but the report shows that 74% of Gen Z and millennials prefer this payment method. Many people among the Gen Z and millennial demographic are active on social media and likely interact with Shopify powered brands as well. So, from a valuation perspective, Shopify still stock looks historically cheap. The company's price sales ratio of 14 is hovering near its lowest levels in several years. Moreover, Shopify has done a stellar job getting costs under control and generating positive free cash flow recently. This has helped the company strengthen its overall financial position and invest in new products and services. With shoppers taking advantage of a longer holiday shopping season, Shopify can benefit from the resulting tailwinds. Furthermore, given the stock's discount to its previous highs, this is an opportunity to scoop up some shares at the bargain. Okay, smart TVs are becoming more common as people cut the cord with cable providers. Advertising dollars are moving away from traditional television formats to streaming services. Kathy Wood is forecasting that Roku will be a major beneficiary from both of these trends. Roku stock currently trades for roughly $100, and Kathy Wood sees massive upside. Okay, over the last several years, cutting the cord with cable providers has become trendy as people flock to streaming services. While Netflix dominates the streaming market, there are a number of other players looking to compete. Art Invest CEO Kathy Wood, who is known for her lofty forecast in emerging tech, is batting big on a budding streaming platform called Roku. According to Wood's analysis, Roku stock could reach $1,500 by 2026, implying 1,340% upside from current trading levels. Let's assess Wood's forecast and compare the assumptions to Roku's actual performance. What's behind Wood's forecast? Wood is known for sharing her logic behind bullish calls. In the case of Roku, Art Invest published a financial model to its website, which breaks down the firm's assumptions behind the $1,500 price target in Roku. The model includes three cases: downside, base, and upside. The $1,500 price target comes from Wood's upside case. In the upside case, Art Invest projects that Roku will reach $32 billion in revenue by 2026. The core assumptions behind this revenue target stem from the growth in connected TVs. CTVs are commonly referred to as smart TVs. Those that can connect to the internet and stream content via apps like YouTube, Netflix, or Roku. Smart TVs, those that can connect to the internet and stream content via apps like YouTube, Netflix, or Roku. Wood's model suggests that by 2026, over 1.3 billion CTVs will be in use. Of that cohort, Roku will reach 186 million accounts, with each streaming 5 hours of content per day. By accumulating such a critical mass, Wood believes that Roku will command premium spend from video advertisers. While Wood's theory is easy to follow, there are some assumptions that need a reality check. How is the company performing? According to Roku's third quarter earnings ended September 30, the company has 76 million active accounts. Right off the bat, Wood's forecast of reaching 186 million accounts within the next 3 years seems lofty. What's more is that attaining this figure is largely out of Roku's control. Roku has no real control over the pace at which smart TV adoption moves. Furthermore, not every CTV is necessarily using Roku's devices. But where Wood might be accurate is streaming hours. Roku's quarter three data shows that the company generated 3.9 streaming hours per day per active accounts during the September period. Given this data point, Wood's assumption of Roku reaching 5 hours of streamlined content per day might be feasible. Where Wood's model really seems to shift from a reality is the assumption behind total revenue. Should Roku achieve its fourth quarter sales guidance of $955 million, the company will generate $3.5 billion in revenue for 2023. In order for Roku to reach Wood's 2026 projection, revenue will need to 10 times in the next 3 years. Not only is this highly unlikely, but where the revenue stems from and its contribution to operating profits are even more suspect. Would suggest that video advertising will contribute the most revenue over the next few years and help Roku attain 67% gross margin. Roku's platform gross margin, which is where ads reside, has hovered around 50% through 2023. Moreover, it's important to point out that the biggest streamer out there, Netflix, has only recently returned to advertising as a revenue source. And as of now, it's not exactly a rocket ship. The point here is that there is a lag between accumulating users, enticing advertisers to your platform, and actually monetizing a meaningful portion of your accounts. Okay, this is it tonight, and I hope you have a good night. Okay, see you and bye bye. Yeah, bye bye, everybody.